I want to answer some questions that were asked um, yesterday, but I didn't get to address them. And I think Arm was the one who asked these questions. He wanted to know about the scoring system behind the tell sheet 12. The first question was, could you please share the methodology you use to assign a score for each stock within the range? And this is what you all see. I send this out in the morning email. Um, and that is, he's referring to this scoring here. It's based on a or 0 through 4 scoring system. Two of the elements are based on the trade and intermediate trend lines. And we're basically looking at, is the stock price above the trade trend line or is it below? And the same with the intermediate trend line. So those are the two of the four elements. The other two are what I've spent 25 years of my life trying to figure out, and those are based on price, volatility, and volume. And I've created a formula that looks at those three elements and how they correlate to where a stock is positioned when it comes to resistance and support. Um, as you're, as you know, as in this case, to break down the scoring a little bit, you'll see that a score of 3 actually gets a full allocation of 8%. A score of 4 gets an allocation of 6%. Why the difference? You would think the score goes up higher, you would get a bigger allocation. This is part of the risk management process of this. What the score of 4 is telling me is that in a period of time, the stock is getting towards a resistance level. It's made its move up, it's rised up, and now we're into a resistance level, and that's where this price volatility and volume comes into play and comes into my calculation. And so I reduce risk by reducing the percentage of allocation there. Now, the portfolio will always hold at least 1% in holding because I just don't know when the market stock's going to rebound, uh, if it's going to go higher at some point. So I want some sort of exposure. And as scores go up, that allocation changes as well. So if I go to, say, a score of 2, you're going to see about a 4% allocation to that individual position. So two of the, I'm willing to share two of the how I score, how make the score up. Two of the elements, which is the trade and intermediate trend lines. The other two, I'm not going to give that way. That's the black box. Second question was, when you decide to add a new stock to your portfolio, um, do you redistribute the allocation percentages across all existing holdings? No. If, for instance, let's say hypothetically, IBM here gets doesn't meet my qualitative standards, and every 3 months, since this portfolio went into inception on June 16th, 3 months from then, I will go through the individual positions and look at it from a qualitative side of things. This is the human factor, not the quantitative, which is mathematical. And I will go through, and let's say IBM doesn't meet my qualitative standards. I remove it and replace it. I'm only going to adjust that percentage that is then calculated on a qualitative side of that position that is being added, not rebalance the whole portfolio. So I'm looking at the individual positions from a qualitative side and individual positions from a quantitative side as well. So no, I would not rebalance the whole portfolio. And then the third final question is, in case where a stock underperforms or does not meet profit expectations, do you fully exit the position or simply reduce the allocation? When it comes to the stock, let's say use IBM as an example, it scores a 4 right now. So, and it gets a 6% allocation. We've reduced that allocation by 200 basis points because of the other metrics that I use is indicating to me that we're seeing a topping in this port in that side of for IBM in this case, and we should expect some level of pullback. So I'm taking profits since it's uh, with the allocation change. If a stock underperforms from a quantitative side, that allocation is going to adjust downward based on the scoring system down towards a minimum of 1%. If at the end of the 3 month period, it doesn't meet my qualitative side of things, then it is removed from the portfolio and replaced with something with another position from Kerry's tell sheet. So all these stocks are coming from Kerry's tell sheet, number one. Number two, I look at it from a qualitative side from my 25 years of experience in applying that to the stock selection. And then a quantitative side, I'm using the mathematical formulas I've built and have accumulated knowledge over the last 25 years of my life and applied that. So if a position is underperforming, the allocation is going to adjust. If at the end of 3 months, the qualitative side breaks down and is not meeting those expectations or those guidelines, it is then fully removed. So really the quantitative side dictates the allocation to a position. If it's underperforming, the quantitative side is going to dictate the allocation percentage. So it's all based on mathematical formulas and basically my version of an algorithm. That algorithm will always, as I learn more and adjust more, or I learn more, I will apply that to this to get this even more and more dialed in. So I've put together, returns based on if you just equal weighted this since the beginning of the portfolio on June 16th, you'd be up 14%. I look at that and I go, that's all because of a rebound in June. I've made that statement in Kerry's call last week that June returns are based on a drawdown in April and May, and you're getting a slingshot return where the um, true performance of the portfolio will be, in my opinion, going forward over the next, say, 3, 6, 12 months. This is when markets all have, we're seeing all-time highs on the NASDAQ and the S&P. We're seeing stocks hit all-time highs. This is where the true performance of this portfolio will come into play is going forward versus a rebound of June. Year to date, this is if you hypothetically, this is if you had equal weighted these positions at the first of the year. This does not take in the allocation changes. I'm building a script to calculate that to give you a true understanding of how this is performed. With the weighting system, it would be up 31.27%. Not a bad day, but take into account the majority of that return, if you equal weighted it on January 1st, came in June. That's how big June was when it came to performance. So I'm excited about this. This is something I've been working on for a long time, and I've used this in the 12 portfolio if anybody keeps up with that. But this is based on math. I'm trying to eliminate as much of the human factor as possible and allowing the math and price volatility and volume dictate how I allocate my portfolio. But most importantly, risk manage around preserving profits. So,
Hey, Trent,
um,
there's a question I want to read to you. You probably don't see it. So, Robert Barry asked, why does AEHR rated 3 on the tell sheet 12, but has a carry score of AFRM rated 4 on the tell sheet, but has a carry score of 60?
Kerry's weighting and how he scores his system is Kerry's formula. Um, my qualitative side of things comes from a different approach to looking how stocks perform. How he scores that's his black box. That's how he does it. Mine is different. I'm just using Kerry's tell sheet, his commitment sheet, and his watch list, and that's my library of stocks that I'm playing with because a lot of people are following his portfolio. And so I wanted to create a portfolio that took that, but applied my qualitative and quantitative portfolio. So how he scores it is totally, I don't even look at it, to be honest with you. I just
Uh,
take all of his stocks and break it down into my system and apply it. So it gives you another viewpoint of how to use that library of stocks. So I don't know why it scores what it is, but AEHR is doing pretty okay since the inception of this portfolio. So,
Trent,
and it
I,
looks like it's going to open up higher today as well. Yes, sir.
I think the difference also is that Kerry's looking for a 3-year outlook. You may be looking for 6 months to a 1-year outlook, so your grading may be different because of that.
Absolutely. Yeah,
Yeah.
absolutely. And that's a very good, thank you for sharing that. That is, I'm looking at this, my qualitative side of things takes in rate of change of earnings per share, revenue, debt, all this other stuff. So I'm looking at things that, say, a hedge fund would be looking at when it came to earnings and fundamentals of a stock. Kerry looks at it a lot differently than I do. So that makes those differences. He is looking at 3 to 5 years. I'm looking out over, at the most 12 months. So that's how thanks
I
for
have
bringing that
another
up.
question, Trent.
Yeah.
Let's say somebody wants to follow your tell sheet 12 on
Okay.
any random given day. What would be the strategy to start? Would you start purchasing the stocks that have a score of 3 and just start building up on it slowly and sell them off or reduce your shares when they reach the score of 4? Is that how you would do it? Just
Yeah, I mean, that's the biggest challenge with when new money comes into a portfolio. And I can see that in the mutual fund world. I can see that in the financial advisory world. You come in mid-year. I wouldn't come into this today. I would definitely wait till Monday when we get through a long weekend and below a higher a normalization of markets. But if I was coming into this on Monday morning, I would say follow the allocation and start there with the expectation that that allocation could change based on market conditions, based on the metrics that I'm using in the short term. Um, and so have that in mind, have that leeway that you may be making some adjustments in the first 30 days of this portfolio. But since this inception, I've seen this allocation changes, and I'm going to build out a historical change in allocations starting from June 16th going forward. It's a matter of programming, so I'm figuring that out. But it'll give you a history. What I don't want to do is this becomes a day trading portfolio, and that is not the intention. If this holds between scores hold between a 3 and 4, and they hold that for the next 3 to 6 months, that's little adjustment you're going to have to make. This becomes a nice addition to your core portfolio overall. And that's the way I would look at this portfolio is this is a high beta, meaning higher risk portfolio than in comparison, say, the S&P 500. So if I'm building my portfolio structure overall, I have a core portfolio that has more conservative, low beta, includes, some balancing of bonds and equities or some sort of opposite correlation there. And then I use a satellite approach. And I would use this as a portion of my satellite approach. I would use my portion of my swing trading as a satellite, another satellite. So what you're doing with this portfolio, the tell sheet 12, and swing trading is adding alpha or energy or oomph to your overall returns. And if you think of it that way, this is one of those pieces, that's one of the three legs of the stool of your portfolio long term, like Mark uses Berkshire, Bitcoin, and who knows whatever else as his core. Berkshire goes below 200, Mark's not flinching, for his core portfolio. He's in it, right? Bitcoin goes down, he's in it, he's still there. Um, this is this is a satellite of that core, the tell sheet 12 is. and it gives you another level of risk element to it. And then your swing trading is more short term, and that is another level of risk. And so over time, probably on a quarterly basis, you sort of rebalance that to manage your overall risk. That's what managers do. That's what true fund managers do overall. So this is more of a additional risk element to your overall portfolio. Does that help?
It helps that you say that you start now and then it takes about 1 month for you to finally adjust and start gaining start getting gains on the profit on the
Yeah.
stocks. But
Yeah.
yeah,
And the thing is,
okay,
like I'm looking at AEHR. I'm in that, I'm up, in that position. Um, and right now it scores a 8, yeah, 8. So I expect AEHR, when I look at the chart of AEHR, I expect it to adjust down to a 6. I mean,
got
to
it.
6% allocation, because it filled that gap that we talked about for the last couple of days. I expect resistance there. So I expect tonight, possibly Monday, that score to go from, a 3 to a 4, and that allocation to go from 8 to 6. And that's why I'm like,
Sure.
probably start on Monday if you're really truly gonna commit to this.
That's what I
Um,
intend to do. I will start investing and following it on Monday and
I
just see what
appreciate that.
happens. Thanks.
Yeah, and I as like anything new, you don't bet the farm on it, and you build confidence and you build trust into it. And I think that's overall investing. You don't go hog wild and put your whole life savings into one strategy after a day. You get used to it. You build trust into it, and that's really what I'm trying to do, is incorporate Kerry's philosophy and his view and bring my world of quantitative and my outlook of 12 months into this, bring these two together. And yeah. So as I said, as I learn more, I use a lot of I use a lot of mathematics behind this. So what I'm trying to do is mimic what they're doing at Citadel, what they're doing at some of these big quant funds, is bring in the mathematical elements that probably 85% of all trades made today is based on. And I'm trying to bring it down to a simple approach for you all.
I
And
got a name. I got a name for it. Quantmeyer.
the what?
The Quantmeyer.
The Quantmeyer.
Yeah.
you.